Don Durrett, author, investor, and founder of goldstockdata.com. Welcome to The Competent Investor. Thanks for joining me today.
Yeah, Tom, first time on your new podcast. Glad to be here.
Thanks, sir. Thank you for being here. Thanks for the support. And I wanted to start today, Don, by kind of getting your, let's say your current feeling on, let's say the bullishness that was raised by the current or the Fed's recent cut here. You know, the markets are down somewhat since the announcement. Do you think this is due to the uncertainty of Powell's commitment to the December rate cut, or could this be more to do with the fear trade that you've been talking about?
Well, we've been waiting, more than a year, more than 2 years for this economy to crack. Many people thought this was going to go into recession as 2 years ago, and it's just held and held and held. But it's been a slow deterioration on top of that. It hasn't been, the Fed and Wall Street has been trying to tell us that this is a strong economy. This is a strong economy. And they basically narrow in on the data points they like to see. They narrow in on GDP growth, unemployment, earnings. Those three are kind of the big ones, right? They focus on, let's just look at these, and they don't really look at a holistic picture. But the holistic picture is a whole different story. So we've been seeing this steady decline, 2+ years, and you could say that it actually been a steady decline since the year 2000, because 2000, when the dot-com bubble burst, then followed by 9/11 in 2001. From that point forward, the U.S., we've been adding debt at an unbelievable pace, if you will. The national debt in the year 2000, before it all popped, was about 5 trillion, and now it's 38, and adding about 2 a year. Everything kind of broke in 2000. So you go to the 1990s. In the 1990s, we actually balanced a budget in 98, 99. The economy was somewhat strong, somewhat resilient. Gold was at $250 the whole decade. Gold was dead. The economy was growing. That was the internet, when the internet was taking off. And that you could make an argument that the US was the dominant economy in the 1990s. But everything changed in 2000. And from that point forward, we've literally been living on debt. And now, by doing that, it's created asset bubbles. First we had the housing bubble, from 2000 to 2007, which popped. And then, but in addition to the housing bubble, we also had, that wasn't the only asset that kind of got, out of whack. We had dislocation. Money was not going into, because we had kind of cheap money, it wasn't going into more productive, so we put it into housing, we put it into the stock market. And then the Fed took interest rates to zero, which was kind of insane when the economy was growing. So they were manipulating the economy from 2009 till 2020, when COVID popped. But all through that area, why was debt? We were growing from 2009 to 2020. The economy was growing, right? Yet the debt bubble was growing. Why? We were growing on debt. It was a fake economy, if you will. It was an engineered economy, engineered low rates, engineered money printing to keep the economy growing. We basically adopted MMT, which we learned from Japan. So Japan, when their bubble burst in 1989, everybody said, well, you need to let these companies go bankrupt. You need to let them go bankrupt. In Japan, they decided they didn't want to do that. Instead, they just started printing money. And it didn't create inflation, but it didn't create growth either. It was like pushing on a string. They kept printing money, and their debt, now that their debt's higher than ours. Our debt to GDP is like 120%. Theirs like, I don't know, 135 or something. But they printed all through the 90s. They just printed, and it prevented them from having a deep recession. They would have a little bit of growth, and they would go a short recession, little growth. So they basically, like the zero growth line, they kind of went up and down, but they never went down very severely. And they go down a little bit and they go back up. And they were basically, what they were doing, the Central Bank of Japan, what they were doing is they were manipulating the economy through interest rates, they actually had negative interest rates and they had the 10-year basically pegged at zero for the whole decade. So they were the first guys to have the zero rates, right? So we copied them. The 2001, we started printing money and they're like, well, if Japan can do it, we can do it too. We don't need in 2007, especially 2007, 2008, as 2008, 2009. We're like, hey, we can just print a bunch of money and then lower rates, in modern monetary theory, and we don't have to worry about inflation. And it worked from 2009 to 2020. We didn't have any inflation. They were printing money. Janet Yellen actually said when she was the chairman, she actually said, we're not going to have another recession in my lifetime. That's what she said.
Right.
We're not going to have one because modern monetary theory. We know how to fix this now. We just inject money.
Yeah.
We learned this from Japan. There will be no more recessions. But what that did was it created a deteriorating economy, underlying economy, because it wasn't a healthy economy. And so what happened is that we started bifurcating the rich and the poor, or the rich and the middle class. And the middle class, it had already started being hollowed out in the 80s when we went to globalization. The middle class started getting hollowed out, where no longer could a middle class family basically live at the same standard of living as in the past. Their income wasn't keeping up with the Joneses, if you will, and it was getting worse and worse and worse. And what we saw was the top 10%, and especially the top 1%, they were the beneficiaries of all this. Mm-hmm. So America was slowly bifurcating, and it's getting worse and worse and worse, and hollowing out basically the wealth of America. The middle classes was always the backbone of America, what made it great. And so we've been hollowing that out and getting worse and worse and worse. And then 2020 hit, COVID, and we're so used to printing money that we didn't even blink. Nobody even thought about, if we expand debt, it's not a problem. The Federal Reserve had, prior to 2007, their balance sheet was under $1 trillion. It was like 800 billion or something. Maybe, and historically, it was all about 250, 300 billion. It wasn't never that much, right? Mm-hmm. Then it started expanding in 2007. And then 2020, they took it all the way up to $9 trillion. And nobody blinked. And that was all money expansion. And then the federal government, they started printing like crazy as well. And everything, they basically threw all this money into the system, and it created a cost of living problem. It created an inflation problem, which exists today. So today, about half of the families in this country cannot pay their bills. Half, which is insane. Now, what they're doing is, when I say pay their bills, I mean their budget, not necessarily, so they can go without. So they look at the family budget, how they used to live. This is how we used to live, right? Well, we can't live like that anymore. And so it's like, we can't. Okay, so I'll give you an example. So let's say we go out to dinner on Saturday night budget, right? And so now that's gone. It's like, I know you can't afford to go to dinner on Saturday night anymore. And then we use travel, right? We go to Disneyland once a year. No, that's gone. That's what I mean by they can't pay their bills, in that they can't live like they used to live. They have a cost of living problem. And then it's not, so once that cost of living problem started, it exacerbated, because then, once your budget basically is broken, if you will, it tends to get worse and worse. In other words, now you have a bill, your savings goes away. You don't have any savings, right? And then you get a big bill you can't afford to pay, and suddenly it's on your credit card, and now your debt goes up. Mm-hmm. It exacerbates. And the other thing that it exacerbates is small business. So people don't have any discretionary spending, excess. And so the local businesses all suffer because they don't have any excess spending. Their budgets is basically limited on what excess discretionary spending they have. So they're not going to the local business and spending money. And so a lot of the fast food, we saw Chipotle's, their stock go down significantly last week. It's down like 50% for a year. And, Chipotle is actually one of the better fast food chains, and they're having trouble. And that's what I mean by discretionary spending has been squeezed. Well, that slowly and steadily impacts the whole economy. For instance, commercial real estate. Commercial real estate basically became, that's one of those bubbles that was created from money basically being, used in inefficient manners because we had cheap money. Cheap money, these people, buy these commercial real estate, and then COVID absolutely popped it, where everybody working from home. But that, because the economy has been slowly hollowed out, slowly weakened, that's just another example, but there's more and more of that.
Mhm.
So right now, Wall Street, you look at the stock market and you think, oh, stock market's at an all-time high. It's 1% from an all-time high. And you go, everything must be okay. GDP's at 3%, unemployment's at 4.2. Everything's got to be fine, right? It's not fine. It's basically economy that's been slowly hollowed out over decades, that's highly leveraged, that has a lot of weak areas that are basically riding, on basically on sand or a house of cards or on air. These things are just barely hanging on. And the banking system and the bond market is kind of at a certain point, those institutions will be impacted. Scott Bessent actually this week came out and he said that next year you can expect strong growth with low inflation. And that's the spin that we're hearing on Wall Street. That Wall Street actually believes him. They actually believe that that's what's going to happen.
Mhm.
And it's a possibility, but I think it's a small possibility because we're seeing, if you're paying attention to the tea leaves, you're seeing the deterioration start to pick up steam. It started in late spring of last year, where the employment, new added jobs starting to go down. You really need about 150, 200,000 jobs a month for a healthy economy because of the turnover and new people coming in. And this one, we're starting to see it, sub 50,000, and which is kind of a signal that the economy is weakening, if you will. And we're seeing a lot of the retail companies, struggle, if you will. The Targets, and then a lot of the restaurants where I mentioned Chipotle,
Well, even I think it was FedEx or one of the big
UPS.
delivery carriers laid off something like 45,000 people kind of coming into Christmas season. Like that's unheard of.
Yeah, absolutely. Yeah, UPS. But
Mhm.
when they announced that, they actually said that they've been doing that all year long. That wasn't an announcement per se. That they actually had laid that many off over the year. So it's like they held off, and they said this is how many. I don't know how many additional jobs it would be, but they weren't gonna lay off that many right now, right before the season. A lot of that started early this year,
Mhm.
so it wasn't quite as dire, if you will. But just they did. I don't think they did a good job of announcing how they were going to do that. But yeah, we are seeing it. Amazon, they laid off a bunch of people too right before the holiday season. But we think a lot of those were kind of white collar jobs per se. We don't know for sure,
Mhm.
but we do know that it's slowing. But there isn't, an absolute indicator saying, okay, we're going to go under. We're going to the stock market's going to crash. In the next quarter, next 2 quarters. But what we do know is that we see the direction we've been heading in, and it's, in my opinion, it's impossible. There's two. Actually, this conversation needs to go for another hour. There's two things that are playing out here that I don't think that can be stopped. One is the recession. It's the business cycle. I don't think that it can be prevented. Once things start to go down, it's almost impossible. This is the reason why the business cycle always happens. This is why you don't prevent recessions, is that, once it starts to roll over, there's kind of no stopping it. And I think that is inevitability. And the second point I would make is that this is an unusual recession in that it's somewhat similar to the late 80s, where we had inflation, and how do you fix inflation? And basically we fixed inflation, and then the economy started growing in 82. But this time we're not fixing inflation. This time the Fed is pivoting to make sure that we have economic growth. And so instead of fighting inflation, they're fighting the recession, which I don't think they can prevent. And so they're going to try to fight. They're not going to fight inflation here. They're going to try to fight the recession. And when the recession comes, at that point, basically the Fed is kind of in a box here. They're kind of trapped. Are they going to pivot back if we go into recession and we have stagflation? Are they going to pivot back to fighting inflation? If they do that, then the recession lingers. It's like they don't really have the tools to fight both things, to fix them both. So they got to fight one or the other. And if they try to fight them both at the same time, I have been expecting this next recession to be a lot worse than people expect because of this problem for the Fed, and that for it to linger for a long time, maybe the rest of the decade, kind of like what happened to Japan, where Japan couldn't restart the recession, and I don't think the Fed's going to be able to restart it. And I think they're going to have to do a reset to the financial system when they can't restart it, because if they can't restart it, the bond market's going to steadily weaken. Because if you're in a recession, then all that leverage is going to start blowing up, and the Fed's going to be printing money. It's just going to be a big mess. And then at a certain point, they're going to go, this isn't working, people. And I think that's when you get the reset. And I think that'll happen in 27 or 28.
Mm-hmm. Well, I mean, going back to this idea, Don, that you've written about, and this idea of, let's say, the debt growth versus growth of the economy. The debt growth has grown 8% per year, and let's say your economy is growing generously, let's say 3 to 4%. We can take government spending out of that. There's all these different things, but even at a generous number, you're growing 3 to 4%. That's not an equation that you're going to be able to manage. That's just the debt side is growing too fast.
This is probably the most important point, is what you're saying. Yeah, and I've been saying this, that since 2000, debt has grown at 8% annually. Mm-hmm. And that's untenable. It's unsustainable. And what people don't realize is that slowly creates problems. It steadily it creates an over-leveraged system, and it is at a certain point, the economy won't be able to sustain it, won't be able to. And the one place that's become very obvious is the bond market, right? So the U.S. government is paying, because of all that debt growth, $1 trillion annually in interest payments. And they're not going to be able to get that down anytime soon, because they won't be able to take interest rates back. And when you have a debt of $38 trillion, you got to get interest rates down to 1%, which I don't think they'll be able to do. So we're going to have high interest rates. So not just that, but we're seeing it also, if you want to buy a house. So housing affordability is at kind of an all-time low because of high interest rates. That all came about from the debt, right? If you go to buy a car today, high interest rates, again, from the debt. And so the debt, as it's grown, now it's a problem. So debt has become a problem. So exactly what you said. It's not sustainable. It leads to a problem. Well, guess what? The problem is here. It is at our doorstep. And the only reason why I own gold and silver mining stocks, the only reason is because of the bond market. And the only reason, in my opinion, the only reason why gold's at $4,000 today is because of the US bond market. Everything else is extra, is added on to the bond market. If the US bond market was solid as a rock today, let's say the US government only had a $100 billion deficit and we had $28 trillion GDP, we wouldn't have an inflation problem, we wouldn't have a debt problem, and everybody would be happy. Gold would not be at $4,000. It would probably be at $2,000 or maybe less. Gold is at $4,000 for only one reason, and this is what Wall Street gets wrong. It's mind-boggling to me. Somebody was asking, why did gold go from 3,000 to 4,000? Why did it go up so fast? 2004. I don't understand this. It's like, look at what we just talked about. Look at the debt expansion in the U.S. and look at all the ramifications of that, all that over leverage. Mm-hmm. And how do you maintain the U.S. the bond market? How do you basically, if it's growing and you have interest at that rate, how much longer can you do it? Right? Can you? And this is the question. This is the reason why I knew that eventually it would fail. Is can you monetize the whole thing? Can the Fed monetize 2 trillion, 2.5, 3 trillion a year all by themselves? Kind of what the Japanese central bank did when
Mhm.
they bought all the 10-year bonds. The answer is no. And the reason why it's no is because they would print so much money, it would destroy the currency.
Mhm.
And inflation is the economy killer. Inflation is the worst of the worst. That's what destroys your economy, destroys your currency. And that's the reason why you get a reset, because at a certain point you realize if we keep printing this much money, we're going to destroy the currency, destroy the economy. We can't do it. We have to stop. We have to pivot. We have to come up with a plan here. We have to reset. And I always knew that's the outcome here, because once you start down that road of increasing debt, once you start down that road, and that's your strategy. Newt Gingrich tried in 1992, 94, in that period, he tried to basically say, whoa, 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 we can't do this anymore. Okay, Reagan did it in the 80s, and now we got to stop, because Reagan had 250, $300 billion deficits when the economy was growing. And then the economy was growing right after the 92 recession, it started growing again. And Newt Gingrich of the Contract with America said, we're not going to do this. We're not going to live on debt, because if we live on debt, if we start that path, it's going to lead to our demise.
Mhm.
And ironically, Thomas Jefferson, I mean, that guy's the most brilliant American I think ever lived. He wrote about this stuff. He wrote about it. He basically said that if you allow your government to print fiat money, to print their own money and not use gold and silver,
Mhm.
that you're basically going to lose your country. I mean, it's fascinating. It's so fascinating that he could see that if you allow your finances to get out of control, once they get out of control, the politicians, they won't fix the problem, because it creates too much damage. It creates too much pain.
Yeah.
And that's what we've seen. Trump, for instance, $2 trillion deficit on his big, beautiful bill. And nobody really pushed back. Thomas Massey, a few guys, Rand Paul, only a couple guys pushed back on that. Everybody else was like, what do I sign? Elon Musk pushed back, said, what? You can't do that. There are a few voices, but very few. 95% plus of the politicians were like, oh, $2 trillion deficit, that's normal. That was what we do around here. Because the other choice was pain, right? And no, we're not going to go. That wasn't not so that's the problem. That's the reason why inevitably the debt blows up, because the politicians will not pull that in.
Mhm.
You know, Gingrich tried. He balanced the budget in 97, 98, but since then it's been off to the races. I don't think yeah. So even though we balanced the budget, yeah, the debt is still it didn't matter. We were off to the races in 2000, and now there's no looking back. And now the bubbles, everything bubble is about to pop here, and there's no preventing it. Let's put
Mhm.
it that way.
Don, something I wanted to get your take on here is, I guess there's two different or two pieces that we need to separate this out in, and that's the AI bubble. So obviously there's the, let's say, the stock and equity component, the bubble part of it. But the other side of it that I want to start with is what you think that the effect of AI coming into, let's say, the labor market and what it's going to do to replace jobs. What effect is AI going to have on American jobs at this point?
I, I could be wrong, but I actually think AI is a job killer.
Mhm.
I actually think on the margin. So if you think about, okay, so right now we're adding, I don't know, 50,000, 25, 50,000 jobs a month.
Mhm.
It's it's not inconceivable, for AI to basically to remove. 25, 50,000 jobs a month. And so there's so many different areas where AI is useful, where you can replace employees. And so, and then when you combine AI with robotics, I think robots are even more detrimental as job killers.
Mhm.
Um, and so when you combine, so you have to think in terms of AI and robotics, because that's what they do. They take AI and stick it in the robots. And so the combination of just AI software where you can, go to a prompt and answer questions, that in tandem with AI robots, I think is going to be both of those are going to be job killers. And I think we're actually going to have to go to a 4-day work week because that's how many jobs these things are going to destroy. But in the near term, when we're heading into a recession, when we go into a recession, if you will, companies are actually going to be more motivated to use AI for productivity, to eliminate jobs, to not bring people back. Labor is like the highest cost usually on a balance sheet. So companies are actually going to be motivated. For instance, I actually think, for instance, Starbucks, I don't know when it's going to happen, but at a certain point, they won't have any employees.
Mhm.
It'll all be through robotics. The robots will be in there. There won't be any humans. It'll all be done through robots. Like they'll be smart enough to do it, basically.
Well, and I
Once it,
wonder what the capacity or what the appetite is going to continue to be for $6, $7 coffees when, let's say, 70% of the everyday American can't or is not going to stand to keep paying those kind of prices.
right, correct. And that's another side of the coin, the demand side.
Mhm.
But as far as the workforce, I think it's inevitable that robots replace people in those type of jobs. It's too easy. Once they get smart enough, once they can do it, the companies are going to be motivated to use the robots.
Mhm.
Any of the fast food places um, will be using them. I think they'll basically first they'll test it, and once they can do it, I think that they'll proliferate, if you will.
Mhm.
Um, that's just one example. So AI, you asked me, I think it's going to be a job killer. We go into recession, it's going to be harder and harder to find work. We're going to see more and more companies using AI to be more productive, not to have to hire people back, to stay in business, if you will. But there's so much potential with robotics. I remember I read an article a week ago about a Ford executive who went over to Japan, not Japan, I'm sorry, he went over to China, and there was a factory there, and the factory was making cars with only using robots,
Right.
completely 100% robot, and the cars were coming off the factory line,
Mhm.
and the guy goes, "We can't compete against this. It's basically way too efficient. Those robots don't get sick. It's a one and done. You only pay them once." It's like,
Yeah.
so they're uber efficient, and so he basically said we can't compete against this. And so that's just one example of AI basically be turned into robotics that's going to proliferate. And so yeah, and so once this recession starts, AI is actually going to have a negative headwind for the economy restarting, if you will.
Mhm.
Um, people will lose their jobs, and then they won't be able to come back because they'll figure a way to use AI to replace it, so they don't need to hire them back in a lot of different ways. I was thinking just one example of how powerful these robots can be is, how the cars today, they basically have vision where they can see a road, if you will.
Mhm.
So with AI, you could actually, let's say a lawn, if you will, the lawn, you could actually, if once the robot knows the diameters of your yard, once it knows the diameters, and it knows what to avoid, like sprinklers or anything in the path, a tree or all that stuff. Once it's smart enough to do all that, there's no reason why. So let's say you have a company and they basically drop off a container where the grass goes. right? The container sits there, and then they loan you, they give you the robot, the mower, right? And then they come and they pick up the mower and put another one there, and they do the maintenance on it, and they charge you like $50 a month. There's no way. All the lawn places are out of business tomorrow. There's no. If you're going to charge me $50 a month and then you do all that, it's like, but they're so efficient, they might be able to get away with it. And then those things, they have those the vacuums that that we've had those for years and years, right? The indoor vacuums, the AI vacuums. It would be very, very similar and those things could actually mow your yard like every 2 days, just to get, they don't have to do it. They have to wait a week, and they're all electric, right? They recharge themselves. It's all that stuff's coming. That's just one industry, but where you can see them displacing workers. And then, of course, we always talked about truckers, right? The drivers, where the trucks are all, all automated. You don't need any truck drivers.
Yeah.
So all this automation is going to displace workers. It's just a matter of when.
Mm-hmm. So on the other point that I raised there, Don, we have, let's say, the AI bubble as well. Do you think that this plays into something that you've been expecting, and it's this market crash? And this kind of ties into what the Fed is doing at this point as well, where we're in an interesting circumstance where the markets are basically at all-time highs, and yet we have this situation where the Fed is starting to or continuing to cut rates despite the market, and on the other side of it, the labor market being very weak as well.
Well, I'm glad we're coming back to this. So people are going to get a heavy dose of macro here. Yeah, I think that AI is a bubble. They're spending all this money. All these companies are basically competing against each other to see who can build out these data centers the fastest. And a lot of this is going to be basically an overspend for some of these companies, where they're not going to get the bang for the buck back. And then how are they going to monetize it? Mm-hmm. And we don't know that. We don't know how efficient, how effective AI is going to be. But I think that before they can monetize it, we're basically going to go into recession. So they're not going to have an opportunity to monetize it. Probably we'll have to wait and see, because right now, a lot of the AI is free, and so how are they going to monetize it? I don't know. But going to AI, so if you look at the Max 7, big chunk of that is AI. And the Max 7 is 40%. It's 40% of the S&P 500 value. So it's basically we're way overweight, and it's even more than 40% on earnings. It's I don't know the percentage, but it's much more than 40% on earnings, because those are really the only companies that are doing extremely well. As a matter of fact, I heard today that the S&P 500, it was a significant percentage of the S&P 500 right now that's below their 50-day moving average. So the S&P 500 is at an all-time high, and yet you have a significant percentage that are under the 50-day moving average. That's totally unusual. Doesn't make any sense.
Really makes you wonder why people think that it's truly different this time.
Yeah, so the overall economy, that tells you that the underlying economy is not nearly as strong as the stock market is telling us. It's a big red flag. And the irony is that it blows my mind. I mean, when I watch these business shows on CNBC, how bullish these analysts can be with some of these indicators. The Buffett indicator, where you got the market is over 200% of GDP. And Warren Buffett's going, that's a bubble, people. I'm going to cash, and he's like 350 billion in cash, more than half his fund in cash. Huge, tell, if you will. Price to sales, price to book are both at historical highs. We have these indicators that tell us that the stock market, PE about 22 forward, 23 forward. These are at nosebleed levels. These are way too high. The highest it's ever been was in 1999, but back then you had these companies that had these massive PEs because of the .com. We don't have that today. Just that, so in many respects, this might be the highest PE because we don't have those massive PEs that we had back in 99.
Mm-hmm.
And so we have this overvalued stock market, which anybody that's paying attention would agree. And so how do you keep it at these levels going forward? The economy is weakening. We have tariffs that are basically creating headwinds, especially for the auto industry. You go to buy a car, you not only have to pay high interest rates, but you have to pay higher costs because a lot of the parts have to be imported in. So the overall cost of cars is higher. That's a problem. Housing, it's really difficult, for affordability with high interest rates. Not only high interest rates, but high valuations.
Mm-hmm.
That's a problem. Big headwind there. Cost of living, we mentioned that. That's a headwind. And the stock market's overpriced. It's like when you connect the dots, you realize why Buffett's got 350 billion in cash.
Mm-hmm.
And you realize why Jeremy Grantham says this is the most vulnerable market I've ever seen. He actually says that 29 was kind of the worst. This is the second worst. I guess you go back and look at 29. That was a massive bubble. But but he still calls it the most vulnerable. And then Jim Rogers, who's been around forever, he basically says, be very careful. He goes, the business cycle didn't go away. He's warning us. And Jim Rogers has also said that he's expecting the worst recession in his lifetime. And he's been around a while. That's what he's expecting. So these old guys that have been around that are smart, they recognize that we got a problem here. We got a big, big problem. And in Wall Street, the stock market is misleading us. The one thing that we know from history is that whenever you get a bubble and you get a stock market that's overvalued, you get a big problem afterwards.
Mm-hmm.
1929, 1987, 1999, 2007. You get a big problem. That's what comes with it from these bubbles. And this is the biggest one. This is the everything bubble. But this is where it gets worse. Everything that I've been saying in the last 5 minutes, 10 minutes is all focused on internal United States.
Yeah.
That's all been internal macro. Well, guess what? Our biggest threat is external macro by far. It's by far our biggest problem is our international connections. The reason why is because we export our debt. We need foreign money. Right now, about 20% of our stock market right now is foreign money. So it's about 60 trillion, 10% 6 trillion, 20% is 12 trillion. It's about $12 trillion in the stock market right now is foreign money. And that's hot money. It's only here for one reason, to make money. And once they realize, the US is toast, we're gone. Mm-hmm. That's a lot of trillions of dollars that are going to leave the stock market. And that again, that's hot money. That's what happened to Japan in 1989. There was a lot of foreign hot money there, all left. It never went back. So you got that hanging over your head. Then you have de-dollarization, where countries are basically going, we're sitting on US dollar reserves. Maybe we don't really need this much of them. And so they're basically selling their treasuries. When they sell our treasuries, it weakens our bond market, and this is really the crux of the problem here. And you look at Japan and you look at China, they still sit on a lot of our reserves and they can dump them. And that's a problem. And then you got the US dollar, you have de-dollarization, where we're seeing less and less cross-border transactions, especially in the South. China, Africa, Indonesia, all Asia, South America, you're seeing more and more cross-border transactions that aren't happening in dollars. Just recently, China, their largest customer for iron ore in Australia, they basically told them, we're no longer going to buy your iron ore in dollars. So it's slowly happening. It's slowly and steadily happening where we're seeing de-dollarization. This is a big problem. So I actually think that our international problems, if you will, are bigger than our internal. Our internal are huge, because if we lose the international, how our economy basically generates wealth. If we lose that, then we're done. And so I think that's our biggest risk, if you will. So for instance, we go into a recession and the Fed is going to use their tools to restart the economy.
Mm-hmm.
But if they lose this foreign, economic drivers, if you will, then they're in big trouble. They need that. They need people to borrow debt. It's very, very important. So the dollar, needs to be utilized. This is why Trump was threatening. He hasn't done it lately. Isn't it interesting? But over the summer, he was threatening the BRICS and saying, if you move away from the dollar, I'm going to give you guys 100% tariffs. Do you remember that?
Yeah.
He hasn't said a word for like 3 months about that, right? Because he knows that if he does that, he can see it. This is going to spiral downward. If I put 100% tariffs in all these countries, they're really going to move away from the dollar. In other words, you're going to spur it on. He realized that in game theory, that wasn't a good choice. And so that's what I mean. So the international aspect of this is, I think, worse than the internal.
Yeah.
But they're both dire. These are not. This is the thing that kind of blows my mind, that Wall Street is in denial of all this stuff. They don't talk about gold. They act as if gold is a non-asset, if you will, on these business channels. When gold is really the canary that's basically telling us that we have this external macro problem and internal macro problem. Gold is basically, it's the alarm bell going off, going ding, 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 ding. There's a problem here, people. But the issue, it's just like the Titanic. It's like, when they were shuffling, the band around. It's the same thing. We're in denial of what's coming. When in actuality, we already hit the iceberg, and there's no coming back from this. And so we might as well just be in denial and have these kumbaya. I mean, last Friday, closing bell, having a party, kumbaya on CNBC, basically saying stock market's an all-time high, everything's great. Best. I remember, I hate to criticize these people, but he said it was the best investing environment that ever. This is a good investing environment. This is the most dangerous investing environment ever. Not the best. 180 degrees. I mean, that's what Wall Street does. Wall Street, they spin it, 180 degrees. All the data points, when you holistically, when you put them all up on the board and you add them all up, the negative outweighs the positive by 3 to 1, at least. I mean, I'm being very generous there. And so you can't ignore that. You can't ignore history. You can't ignore the trends, and you need to look at the whole thing. And for the U.S. has basically been the global hegemon since 1945, where we've basically been the power broker, if you will, since 1945. And from that, it's given us a lot of benefits. And the number one benefit is the rest of the world has subsidized our economy. They've subsidized our standard of living. And this is what people don't know. They don't understand this. They don't realize that our wealth, our standard of living, in many respects, has been subsidized through that $38 trillion. That $38 trillion is basically, a lot of that's foreign money. And without it, we wouldn't have been able to maintain our growth rate. So we've been living on the backs of foreign countries. And like I said, this is the reason why the external macro is more important than the internal. Because when we lose that, our standard of living is going to drop, and it's going to drop dramatically. The one topic we haven't really gotten into, and I don't know if we have time to it, is the fallout of all this.
Yeah, absolutely, Don. Like, the idea of understanding the whole picture is really important.
Absolutely. But Wall Street, there was always this saying that you can't have a belief that's contrary to your pocketbook or your paycheck. Your beliefs have to be correlated to your paycheck. You've heard that concept, right? So basically when you go to work, you adopt to the culture, and you have to play that. You have to basically buy into that culture, and if you don't, you're gone. So in Japan, they have this concept of any nail that sticks out gets hammered in, and so that so if your ideas are not congruent with company culture, you're gone. You're going to get found. You're going to get pounded. And so Wall Street, anybody that works in the financial industry, the culture is basically we sell financial assets, and we do it, in America, which is, the number one economy in the world. And America is going to succeed. America is going to persevere, and basically we're going to invest for the long run, and you're going to make money because historically, stock market gives you these returns, bond markets gives you these returns, the old 60-40, right?
Yeah.
That's the culture of Wall Street. That's the culture that you buy into when you sign up, when you walk in the door. And so they throw one analyst after another on these shows, and if they work for a big Wall Street firm, they all say the same thing because they bought into the culture. They can't say what I said in here. They can't bring these topics up because the topics are incongruent with their culture. And every once in a while, they'll bring in, somebody that's a private equity guy. You don't see too many of them. They'll bring in a private equity guy that'll bring up some of these topics. Like, I think Peter Schiff has been kind of, 86 on CNBC. I don't think he's been on in a while because, he basically, he calls them out on a lot of things that I've been saying.
Yeah.
So you don't see too many people bringing this out. And so it's difficult for people to see the big picture because the narratives are everything's rosy.
Well, Don, if and when we get this market crash, how do you see gold and silver reacting? Do you see it getting drawn down and then being one of the first things to respond? And then does that sort of become the catalyst to Wall Street really recognizing the miners and the cash flow that some of these companies are actually throwing off?
I'm glad we got to this topic because I thought this is where we were going to start since I'm a gold and silver guy. So gold absolutely broke out in August. Excuse me, silver broke out in August. Gold's been broken out since December of 2019, and it really exploded in March of 24. But that's when it broke through 2,000 and went through 3,000. It just took off like a rocket. And then silver joined the party. And when silver joined the party in August and went over 40, that was really the beginning, if you will. That was the first real surge, if you will, in the bull market in the mining stocks. So the HUI basically, I think the HUI became a bull market. So let me back up to it's like March, April of 24. At that point, I basically lost all fear of gold doing any deep correction. So gold is down 10% here. It's down 10%, 39.40 as I talk, and it might go to 3,700. It might go down 15%, but that is pretty much as low as it can go. And that's, if you look back in 2008, 15% isn't really that deep of a correction, and I don't think it'll last that long. Hopefully, it won't go down to 3,700, but it went all the way to 4,371, almost $4,400. It made quite a run here from August and September, and then silver just took off, just blasted off, went all the way to 54. We'll call it 54.50. Quite a run, and now it's corrected 13%. It's at 47.21 today, and I think it could correct all the way back to 42, which would be about 23%. But we broke out at 4. As long as we don't go back and retest 40, that's fine. In August, we could retrace almost all the way back through August. That would be pretty nasty. The HUI's corrected. It was at 693, and we're back to 555 today. So we've corrected 20% on the HUI. The average gold and silver investors portfolio is down probably 25, 30% because the HUI is just the big caps.
Yeah.
And so it's been a significant correction here. Um, I was hoping, that we would bounce out of this. That we had this was the first run, this was the first move, if you will. But we are in a bull market now. The HUI did go into a bull market, so we went up to 693. This isn't the end. This isn't a one and done like like what we saw in 1980 and 2011, where we go up and hit these all-time highs and then crash. That's not what this is.
Mhm.
This is the first wave. And there's going to be two more big ones, two more big waves. So this one's probably the HUIs that got all the way to 693. I think it'll go all the way back to 500 to 525. So probably about a 28% correction off the top, which is going to be nasty. I was hoping it wouldn't be that deep. I was hoping we'd only have like a 4 to 8 week correction in gold. Now I think it could last 12 weeks. We could go sideways here. But again, this is the first surge here in the bull market of the HUI. And then the next one will take us to it'll double again. We'll go to 1,000. And that one is actually going to be the easier one. The first one's the hard one because
The HUI.
The HUI and the gold and silver. Yeah. This first surge is the hard one because this is the one nobody believes.
Right.
Right? You break out, it's not going to last, and everybody jumps off the ship, right? So we've had this severe correction here because nobody believes it. But the next wave, the next one, not only will everybody believe it, but that's when everybody comes in. So there hasn't been a lot of players that come in. Wall Street's not involved. When the S&P's at all-time high, Wall Street's not going to be buying a spec stock. They don't buy speculation stocks unless they have to. 2002 to 2007, that's when Wall Street was kind of flat and the HUI was moving, was really ripping higher. The HUI went from like 100 to 600 from in that period. So it was ripping, and so the stock market was flat. So the next surge will occur. The ugly part is I think we are going to correct down deeper than I was hoping. I was hoping that, and it's still possible. We're in November. It's possible that we could have. I'm hoping we get a correction in gold and silver and the miners before the next dip, if you will.
Mhm.
But we don't know do it. But I do think we're gonna go much lower. Not much. We're gonna go lower than we're at now. I believe. When the S&P now, that next wave up, the HUI going from 500 to 1,000, that second, doubling, if you will, that's going to occur after the stock market basically begins its crash and stops going higher. That's when you're going to get a rotation out of stocks where Wall Street finally goes. So basically, once the Mag 7 roll over and there's no place to make money in the S&P, they're going to turn around and they're going to look and they're going to say, wow, those stocks are up big. I mean, Newmont up 100%, GDXJ both up about 100%. I think I need some of that, right? It's like 100% in a year. Gold wants to trend higher. I think I need some of that. So you're going to get a rotation into the miners. That's when it's going to be much easier to make money, because once everybody gets on that boat, once everybody gets on the train there, you're going to have people will buy any dip. So you won't get any. We won't see any. I don't think we're going to see any 10% corrections before we get to 1,000. It'll be basically shallow dips, and they'll get bid fairly quickly. Those corrections are going to be 4 to 6 weeks probably, whereas this one's probably going to be 8 to 12 weeks. So the first one is going to be a little bit longer, and then they'll be shallower and shallower. But so then I think the next one's going to be the easiest, and then the last one's going to be a bit of the mania. The last wave up is the mania phase.
Mhm.
And that one's dangerous. Right? So it's dangerous early and dangerous late. The middle one's the easy one. So it'll start getting dangerous, 1,200, 1,400 HUI,
Mhm.
because there's a lot of things that can happen when you get into that final wave. And for instance, you could start getting a lot of higher taxes, higher royalties, not so much nationalization, but where countries demand ownership, equity ownership, stuff like that. And so that's what so the risk it just explodes. It'll really, that third wave, that mania phase, it'll be really, really high risk, a lot of and volatility. And yeah, well, and so
But don't you think that that ownership stake or that equity stake by the US government has already started, Don?
well, I'm talking about the emerging markets. I'm
Okay.
not really worried about the US. I'm emerging markets where, especially in the African nations, there tend to be more of the poorer countries that need these revenues. If they see companies have margins of $3,000 an ounce, so if gold goes to 5,000, in Africa, a lot of those are open pits and they're low cost. Most
Right.
of them are like, $1,200, $1,300, $1,400 ASIC. So you're going to have a $2,000 break even. So if gold goes to 5,000, they're going to have $3,000 margins. Now, if they have $3,000 margins, you think those countries aren't going to notice? They're going to notice. They're going to go, man, you guys are just raking in the dough. We want some more of that. So you're going to see that. That's going to absolutely happen. And that's when stocks, the bad thing is that when they announce those, the announcements always come out of left field. Nobody's expecting them. And your stock will go down like, 20% in a single day.
Yeah.
If you're a single asset miner in that country,
Mhm.
now if you're diversified, it won't be as bad. But if you're a single asset, I mean, you wake up one morning and you go, oh man, I was up big and now I'm down 20% on that stock. So
Mhm.
we'll see a lot of that. We'll see. So the volatility in that phase, that final phase, we'll see a lot of volatility like that, and the risk levels will really jump. And the other thing that's going to jump there in that third phase, I think, is silver. I think there's going to be silver shortages. And so when those happen, there's all kinds of different ramifications of silver shortages. That could be negative and highly risky to the investor. We don't know how these governments are going to. For instance, if Apple can't make their phones, what do you think they're going to do? They're going to get on the phone. They're going to call Trump directly, and they're going to go, "I can't find any silver. Can you help me?"
Mhm.
That's what's going to happen, and that'll happen. I think in phase three, because the second phase I think will happen fairly quickly. But it'll happen so fast that everybody. It'll happen next year, if you will,
Mhm.
and it'll happen like in 1 year. It won't take long. It'll just once you get a decoupling from gold and the S&P. Once that decoupling starts, it'll happen fast. Because everybody will be, everybody will see what's happening. They'll see what's happening. It's like gold's going higher, silver's going higher, the miners are going higher, and everybody will jump on the bandwagon. And so I'm now I don't know when this decoupling is going to happen. Is it going to happen January, February, March, April? I don't know, but I'm confident that the recession's coming, and the decoupling's coming. Again, gold is at $4,000 because the U.S. bond market is basically steadily breaking down. And if that increases, if that fragility increases, which I think it will when the recession begins, then gold's going higher with it. You know, it's pretty obvious, right? If my thesis is right about the recession and everything I've said today, and the bond market getting weaker, gold is the benefactor of that. And so gold is going much higher. Um, I think that 50, I used to think 5,000 was easy. Now I think 5,500 is easy. And we're getting really close to where 6,000 is easy. I'm kind of have gotten to the point where for me, it's 6, 7, or 8,000. One of those three is kind of where we'll get to before the reset. Now,
Mhm.
some people say that we're going to $10,000 gold. I'm saying you won't get an opportunity to get to 10,000 because before we get to 10,000, they'll do a reset. And
Mhm.
once they do a reset, gold that's when this bull market ends. And so I think it's going to end when they do the reset, because when they do the reset, I think they're going to create a new dollar, a new currency. And when they do that, then the gold will basically, unless the rest of the world is still burning down, their fiat systems are all burning down, and then gold keeps trending higher. I mean, that's a possibility. But if we start using gold to back a lot of these stable coins, then that could, kind of stable things out. But my personal feeling is that we'll do a reset before $10,000 gold, and we won't get to 10,000. Especially, how do you value gold? Like right now, we value gold using the dollar.
Yeah.
And if the dollar's going away, what are we going to value it at?
Mhm.
Are we going to value it in euros? I mean, that's possible. It could break down against euros, against yuan, against yen. I mean, that's all possible. It's hard to say per se, but I do think 6, 7, 8. We will. I think 6 is becoming too conservative. 6, 7, 8 before the reset, and that'll happen. I think before either in 27 or in 28, one of those two. It's not going to happen in 26.
Mhm.
I'm hoping it happens by the end of 27. But I'm thinking probably 28 before we get the reset. So for me, the reset's going to be in 27 or 28. It just we'll see how it unfolds.
Mhm. Well, Don, you value your mining, your targets for your miners based on targets for gold and silver. What are the targets that you see gold and silver getting to, and how have you come up with those numbers?
Yeah, that's a really good question. The upside. So when I started my created my website in 2012, I was using $2,000 gold and $100 silver, and the $100 silver has never changed.
Yeah.
But gold, it went up. I might have been $2,500 gold when I started. I either 2,000, 2,500. But now gold at 5,000 on my website, silver still 100.
Mhm.
Now, why did I use those numbers? So historically, if you look at what gold did from 1972 to 1980, if you look at the appreciation, and then you look at the appreciation, so it went from $35 to $850, which was a massive move. And then we went in 2001 to 2011, we went from 250 to 1900. So now you go, okay, what's gold going to do this time? And I look at the value, what the price was in 2019, and then you kind of extrapolate it out. You get an idea, how high can it go? And then, if you look at it about, I don't know, 1,500, 1,000, somewhere in there. I forget what the price was in December. I think maybe 1,500. So if I don't think we're going to go up. If you go up, I think 6, is that $9,000 gold or something like that. 5, we don't know if we're going to get so it went down. So the appreciation of gold went down from the 1970s to 2000s. I think it'll go down a little bit this time as well. So I don't think we'll match it. That $250 to 1,900. I don't think we're going to match that. So, but probably 5 times somewhere in there, right? And so then you take that number. So let's say we use $6,000 gold, which is kind of conservative.
Mhm.
I think we're going to go to about 2.5% silver. So if you use 1% of 6,000 is $60. And I think 1%, which is kind of where we're at today, a little bit over 1. I think we're going to go to easily 2%, which is $120. Easy. So my target is 125 to 150, using that 2% as kind of a minimum.
Mhm.
And I think 2% is easy. So 2% of $5,000 gold is 100. So now my percentages all line up. But when I first started doing this, I probably shouldn't have used $100 silver when I created my website, but it's a round number. Probably should have used 75, but I'm going to use 100. I like that nice round number. We're going to get there eventually. But it was out there. But now I'm 125 to 150, and I need to raise my prices, raise my targets on my website. And so it's all basically, if you take gold, so if we do 7,000, which I think is in play here, 1% 70, 2% is 140. And so that fits in with my 125, 150 target.
Right.
And so that's where I think we're going. I think now my 2% number, I think is conservative. We actually got to 6% in 1980. We're not going to 6, but I think we're going to go 2.5 to 3.5.
Why do you think we're not going to 6?
That was crazy times. That was basically the Hunt brothers. The
Mhm.
Hunt brothers kind of made that up. Silver should have never went to 50. It should have probably went to 35.
But if
We
we
should
get
have.
a major supply shortfall, like you were talking about,
I,
you don't
I
think
don't
we're
think
going
we're
to go
going.
like that?
I don't think it's possible, but I just don't think so. I actually think 3% would be pretty amazing. I mean, if you use 3%, it's very, you go well over, you go to basically you get to $200 silver.
Mhm.
And so for me, it's going to be somewhere, and so my target is 2.5 to 3.5. So I actually think that we will get to 2.5, and we could go 3 or 3.5. I think 3.5 is actually in play. That's kind of my, like, the upper limit. But I think $5,000 gold is actually very conservative. So if you 100, so that means $100 silver is very conservative, which is kind of mind blowing, because $100 silver creates some huge margins for these silver miners. So I'm valuing my silver miners at $100 silver right now, and they're all still cheap. If you
Mhm.
go to 125, they get really cheap. 150, uber cheap. So if you get to 150, 175 silver, I mean, I don't even try to even price these silver miners at those levels.
Yeah.
And those silver prices are actually in play here. They're in play. That's why I tell people, I told them, buy the Mormons and just hold on to them, because we don't know how high silver's going to go. I had an email today and somebody said, the Mormons are really run. Do we really want to hold these things? And, he wants to pivot out. He's got profits. He wants to pivot out of the Mormons, and he wants to buy some higher risk stocks. And the problem with doing that is that as this market goes higher, at a certain point, the only stocks you're going to be able to pivot out of are high risk stocks. There's not going to be any more easy 5 baggers, easy 10 baggers. And once we get, after the second phase.
Mhm.
So in that third phase, you want to own quality. Don't get rid of these things. Hold on to these quality names, because those quality names, those are the ones that are going to get overvalued. For instance, Coeur and just New Gold just did a deal, and everybody's selling. I mean, Coeur stock's down to like $13. Everybody's selling this stuff because nobody believes in $100 silver. If they believed in $100 silver, they wouldn't be selling these things.
Right.
And so if you get to $100 silver, every dollar above $100 silver, these multiples are going to go higher. So that we're going to get multiple expansion on a mania phase. So if you go from $100 silver to 150, the quality names, the cores, their multiple expansion is going to be enormous.
Mhm.
So I was valuing New Gold just using a 20 multiple, and it priced out at $34 billion. Using a 20 multiple, and they paid 5.8. So let's say they paid 6. They paid 6. It'll be worth 34 when silver gets to 100.
Mhm.
If they get a multiple, or silver gets to 5,000, or I use 5,500, excuse me. Gold gets to 5,500 and they have a multiple of 20. Now, most people will say, Don, multiple of 20 is too high. Well, yeah, it's too high today, but if you get to 5,500 and you got a mania and everybody wants to own these things,
Mhm.
they're going to push these multiples up, 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 up. You have to expect that, and so um, it's an absolute steal for Core if if gold gets 5,500 or higher and the multiples blow out.
Yeah.
But guess what? Even if they're wrong, if gold only goes to 5,000 and they only get a 15 multiple, it's still a great deal.
Yeah.
It's a win-win for them.
Mhm.
They get optionality. They basically, they get a whole bunch of free cash flow, accretive cash flow, and then they get the upside optionality. That upside optionality is what's important here. That's what they bought. They bought upside optionality, and everybody's kind of ignoring it.
Mhm.
Um, they're selling it off. I mean, it was trading at like $18, and now it's down to 13 something.
Mhm.
It sold off really, really harshly because everybody's thinking near term. They're not thinking that gold's going to hit these high prices, 6, 7, 8. And so I'm going to exit. So I'm not going to wait for $7,000 gold. I'm not waiting for that. I got in early. I'm leaving early. So if when we're at the first place I'm at, my first sell point is $4,500 gold, but only if silver catches up. So if you have a 2% multiple for gold at $4,500, that's $90 silver. So if we get to $4,500 gold, so I'm not selling anything. Get to $4,500 gold, I'm going to look and see what we're at. Where's silver at? If silver's still hanging out at sub $70, I might wait for 4,600.
Mhm.
But if silver's starting to rip, if silver's up to $75, then I'll probably sell something there. And then I'm in sell mode, and I'll sell all the way up to 5,500 or 6,000. At 6,000, I'll be completely out.
Mhm.
And because I'm not going to wait, because the third leg of this thing, that third leg is going to be very, very risky stuff. And so I just assume get out of the way.
Well, Don, when we're talking about these senior, like the bigger producers, what do you want to be seeing from them as behavior goes right now? Should they be paying down their debt? Should they be expanding their resources by buying other companies like M&A heating up in this sector? Should they be, having CapEx around exploration? Like, what do you want to be seeing from these seniors?
Well, first of all, I'm after alpha. I actually want mid tiers. I want to own as many mid tiers as I can get my hands on. The Coors and the New Golds, First Majestics, Pan Americans. Pan American is, but these are not the Elite Eight. So I don't really want to own the Elite Eight unless I bought them cheap and now I'm going to ride them up. But I'm not going to buy them today. The Elite Eight is Newmont, Barrick,
Mhm.
Agnico Eagle, Lundin, Goldfields, Anglo Gold Ashanti. These are I call these the Elite Eight. These are the best majors. So of the best majors, you can buy an ETF. You can just, instead of owning those stocks, you just buy the ETF GDX. But if you want dividends, then it's good to own. I always say let the rich people buy the Elite Eight. If you're rich, I mean uber rich, you should own $100,000 of those Elite Eight, and just sit back and collect dividends, because they all are going to pay dividends, and they're going to pay good dividends.
Mhm.
So if a major doubles, so they usually pay about 2%, 2.5%. So let's use 2%. So if you buy one today, it's paying 2%. It doubles in value. Your dividend goes to 4%. It doubles again, your dividend goes to 8%.
Mhm.
And these stocks are going to double and double again, which is a three bagger. You're going to get 8% dividend. You can't beat that. That's pretty good. So those are really for rich people, if you will. So I don't own GDX. I don't own the majors, although I bought a lot of these majors when they were really, really cheap, and so I'm going to ride them.
Mhm.
Like I bought Kinross. A lot of these stocks, they've been very cheap over the years. But I also own mutual funds and ETFs too, where the majors are in these. So majors in GDXJ. I have another mid-tier ETF that the majors are in, and then I have three ETFs, three mutual funds. The majors are all in there. So my portfolio, I don't necessarily buy these majors unless they're really cheap. If they're
I,
really cheap, I'll buy them. But I'm focused mainly on mid tiers. Go ahead.
Mhm. I wasn't asking, about getting into the majors at this point, Don. What I'm wondering is what you want to be seeing, let's say, for the health of, let's say, the mining industry as a whole at this point. Do you want to be seeing them paying down debt, or do you want to be seeing them going after these M&A targets to expand their resource base? And, as a consequence of that, maybe some of your mid tiers get snapped up as takeout targets.
Yeah, I'm glad I answered it wrong. So viewers got two answers. So what I want to see from the majors is I want to see them clean up their balance sheets. This
Okay.
is one of my pet peeves and one of my arguments with some people that are investors. And most of the people that I argue over this with are people that are looking for short term. They're looking for returns over the next 12 months.
Mhm.
And so they're looking at, how the market, looks at these companies, and the market, my point is that gold mining is a cash business. So you're basically always using cash reinvesting it for CapEx, sustaining CapEx, exploration, and building new mines. And then you're paying out dividends and doing buybacks.
Mhm.
It's a cash business. You need tons of cash to do those 5 things. And so since you need tons of cash to do all those things, the more pristine your balance sheet is, the less risk an investor is going to take. Now, this is a speculative investment, so risk comes into play. These are companies that do not have customers. They don't have customers. They don't have competitors. They don't compete against each other. What they do is they go and find gold, they take it out of the ground, and then they sell it to a buyer. And there's plenty of buyers out there. That's all they do. It's like, how did you do this month? Oh, yeah, sold, yeah, did well. 500,000 ounces, sold it at 2,000. Yeah. I mean, they don't compete against each other. No, it's an unusual business, but it's a high risk speculative business because the value of the company is all based on their margins, and the margins are based on the price of gold. So right now we have high margins, very, very high margins, $4,000 gold price, average ASIC's about 1,700, so about 24. So about $1,600 margins right now, I would say on average. Some companies have 2,000 margins, some have 1,000. But average, let's call it 1,500, 1,600, 1,700. Those are really high margins. So these companies are generating cash. Now, what I want to see is I want to see these companies get rid of their debt as fast as they can.
Mhm.
I want to see a company that has Agnico Eagle, for instance, they're down to $200 million in cash. They will have zero cash. They have $2.2 billion in cash on their balance sheet, 2.2, and they kept 200 million around. They paid some off last. So next quarter, they're going to pay off that final 200 of zero, and they'll have 2.5 billion in cash on the balance sheet. So with that cash, every single month, they get another billion comes in. They can send about 30% of that back to their investors
Mhm.
through buybacks and dividends.
Mhm.
And what that does is it makes the multiple expand. When companies have these beautiful balance sheets and then the cash is coming in and going back out, people want to own those stocks.
Mhm.
And the multiple starts going up, 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 up. Their multiple, Agnico Eagle's multiple right now is like 13, which is low. It should be 20. And the reason why it's low is because everybody's is low.
Mhm.
It's actually insane. Newmont is like under 9 last time I looked, which is insane with their margin. It should be at least 14, 15. And so these companies are all, this is the reason why we're early innings. We're early innings, but like the stock market has a forward PE of 20, let's call it 22. But in mining, because cash is so important, I use free cash flow multiples, which is much better indicator of the health and value of a company.
Mhm.
And so these multiples are low right now, which shows you that we're early in a cycle. As a matter of fact, New Gold, their multiple is 5.5.
Mhm.
It should be double digits. So Coors buying that company at half off. They actually got a fantastic deal buying a company with a 5 multiple. You won't be able, they were a major as well. You will not be able to find a major that mines in Canada, right? Because New Gold's in Canada. That's a multiple that's not double digits probably in 12 months from now. And so these low multiples are all going to go bye-bye. So, and that's when you start to get a mature market. So the first thing we want to see in the majors and the mid-tiers, we want to see these pristine balance sheets where they have no debt and say $250 million in cash or more, ideally $500 million or more. And then that cash just sits there. It just sits there, right? And then all the new cash that comes in goes back out. And so, but they keep they keep a bunch of cash on the balance sheet. That's what I want to see. It is, people don't realize this. They basically say that what debt, this is the normal businesses, is that you can leverage the debt. If you get a low interest rate, you can leverage it. It's good for the balance sheet, but not in mining. Not in mining valuations. I learned this from Kirkland Lake. Kirkland Lake, they had $750 million in cash on their balance sheet. They had low cost, they had huge margins, like today, and their multiple went through the roof. It was a rocket ship. They made everybody look bad. They made everybody look bad. It's like they're making us look bad. So Agnico Eagle took them out. So we got to get that company out of there, right? They were just absolutely beautiful company. And they were showing everybody how to do it right, but they could do it because they had these really low costs in Australia. They had like $400 cash costs, like a $700 ASIC. They had a really low cost, so they could do it. The other companies couldn't.
Mhm.
And so they were generating all this cash. And so they had massive cash on the balance sheet, no debt, and they were making everybody look bad. But now these other companies have these high margins too, even though they don't have low cost anymore. But since gold's so high, they have high margins. And so now they can emulate what Kirkland Lake did. And so we're going to start to see more and more companies start to emulate that Kirkland Lake model, which is that's what we need to do. Okay, so we need high margins, no debt. Now, the last thing is the M&A. M&A is coming. We just saw, what we haven't seen yet is we haven't seen aggressive M&A. Now, Coor, they just got slapped in the face for paying a 16% premium. They paid a 16% premium and they got slapped in the face. Their stock went down, I don't know, more than 10%, I think more than 20. It went down, I don't know, 1650 to 1350, but it was they got slapped pretty hard.
Mhm.
I think that entire 19% premium they paid got sucked out of their share price. So companies are going to be very hesitant still to do deals if they're going to get slapped in the face. Newmont got slapped in the face when they took out Newcrest. And so it's like investors, they don't think in terms of, if they thought in terms of how cheap they were, what the deal that they were getting, in actuality, Coors shares should have went up.
There,
People should have said, wow, they just bought a company with a 5 multiple
mhm.
that's going to be worth over $20 million in like 2 years. I mean, that's how the market should think, but it doesn't think that way.
They're
And
they're
so,
down they're down 24% over the last 2 weeks.
thank you. 24%. Right. So they got slapped in the face. So they went 19% and they got an extra 5% penalty. So companies are going to be, hesitant to be aggressive here. But I'm sure there's a lot of deals in motion right now that are going to happen, and M&A will pick up steam. The one thing, the aggressive companies, and I want companies to be aggressive, the one thing that people are going to realize is that the best thing to do is to be early. They're
Mhm.
going to say, yeah, Coor got slapped in the face, but look what they got. And now Coor, as soon as gold goes back to 4,200, 4,300, and then Coor comes out with a quarter, that stock's going to rip higher because then people are going to start thinking, then they'll start thinking forward.
Mhm.
So I think Coor will get to $20 very, very quickly once gold gets to say 4,300 and stays there. And so it won't take long. My target for Coor was like $80 at $5,000 gold. And so at $5,500 gold, it's a $100 stock.
Mhm.
Now, I think this actually made the company a better company. So my exit price on Coor is 70 because I don't wait for the very top. But after a few quarters with New Gold, they actually produce more revenue now than Pan American. Pan American produces 750,000 ounces of gold and 20 million ounces of silver.
Mhm.
Coor, after this deal, does 900,000 ounces of gold and 20 million ounces of silver. Coor is now a bigger company than Pan American. Pan American mines in 9 countries, 9 mines. And so, Coor's like, I think about half that, maybe 5 mines, maybe 6. But they produce more revenue than Pan American. So they become basically a juggernaut here.
Mhm.
So I probably am going to move my target to $80. So I uh, I I think this is going to be a win for me. Fingers crossed.
Mhm. Don, you mentioned optionality earlier. How do you define optionality, and what are you looking for to invest in that creates optionality for you?
Yeah. So optionality is very, very simple to understand. It's when you can buy gold and silver at the ground below the market price, significantly below the market price,
Mhm.
meaning that if the price, it's basically under the market price at today's gold price. And so if gold prices go higher, it's almost inevitable that the value of that company goes higher. And so so perfect example is Free Gold Ventures, which has always been my favorite optionality play. So Free Gold Ventures got unbelievably cheap. At one time, it was valued like $8 an ounce in the ground. And Eric Sprott owns over 25%, I think like 27%. And then there's another private group that owns about 25%. So between those two private groups, nobody can basically buy that company without those two groups saying yes. And I just don't think that Sprott would sell because it's basically an ideal project.
Mhm.
I don't think he would sell for less than $100 an ounce in the ground. So there's your optionality. Buy it at 8, sell it at 100. And all you have to do is sit back and wait to get paid. That was the ultimate optionality play.
Mhm.
Now, I value that company between 3 billion and $15 billion, minimum 3 billion. So the 3 billion is $100 at 30 million ounces. So if he sold it $100, it would be 3 billion. I think that's the minimum.
Mhm.
But if they do a 50% free carry, which I think is the only deal that I would do, if they did a 50% free carry, it's worth 15 billion
Mhm.
at $5,000 gold. Well, let me explain why it's worth $15 billion. So the free carry, so it would be basically with Kinross, because Kinross is right next door with the Fort Knox mine, and they have the mill just sitting there, and it's only like 5 miles away. So all I have to do is the capex is not going to be massive like most companies because the mill's there. So all you do is build a conveyor, 5 million, 5 mile conveyor, which has been done before. That would be the big chunk of the capex. But so basically what they say is they go, okay, Kinross. Kinross calls up. Let's say the gold goes to $5,000 next year. I think it might go to 4,500, 4,800. Let's say it goes to 4,800 next year. Kinross calls them on the phone. They go, we think gold's going to stay at these high elevated prices. So we're interested in your Golden Summit. We're interested in Golden Summit now. We want to buy it. And they're like, fantastic. We've been waiting for your call. And then they go, well, yes. And so they say, well, we want to buy your company. And they're like, well, we got a problem with that. We don't want to sell. We want to do a 50% free carry.
Mhm.
And the other side of the line is like, crickets. They're like, nothing there. Well, okay, I'll go back to the board. I'll go back to the board, tell you want to do a 50% free carry. And so they don't want to do a 50% free carry, but Free Gold Ventures has the leverage because if it's a 50% free carry, Kinross still makes off. They make off. They do fantastic. So it's going to basically be 800,000 ounces a year production. So at 50% free carry, Free Gold Ventures shareholders get 400,000 ounces a year for like 20 years. It's a mammoth amount of free cash flow. If at Kinross, they get 400 too, and it doesn't cost them a penny. In other words, you do a 50% free carry. So Kinross doesn't have to give one penny to Free Gold, not one penny, nothing. And they get 50%, but they have to pay for the capex. They pay for everything. And then they give 50% of the profits to our shareholders. If they do that, I believe a 400,000 ounce annual I think it's worth 15 billion.
Mhm.
So I'm hoping they do a 50% free carry. I think for me, if I'm on the board, I'm like, that's all we're doing. When they call, yeah, you ready for the 50% free carry yet? No, we're not ready. Okay, call us when you're ready. That's what I would do.
Yeah.
I mean, you think about it. It's a win for Kinross. If they get 400,000 ounces of production and all they have to do is build that conveyor, and I mean, why not do it?
Mhm.
To me, it's a slam dunk. I'm shocked that they haven't offered the deal yet. For me, I don't see why it doesn't make any sense. It makes sense for both companies.
Mhm.
It absolutely makes sense for Free Gold shareholders. The irony is that I told the CEO of Free Gold Ventures, I said, 50% free carry is the best deal for shareholders. And I don't know if she was, being close to the vest or whatever, but she basically said she didn't seem to like it. Like, isn't that because I told her, I said, isn't that the best deal, 50% free carry? And she wouldn't say yes. She's like, no, she wouldn't, she refused to even acknowledge the fact that that's probably the best deal. Because I
Mhm.
said, isn't that the best deal? How can you make a better deal than that? I don't understand. Um, she seemed to imply that there was still a possibility that they would build it themselves. And I've never entertained that idea. I just think that it's too big of a project. Um, but maybe that's what she was thinking. Well, we're going to build it ourselves, so we don't even need to do a 50% free carry. Now, there is no doubt they could build it, but the problem is they don't have the mill. The mill's next door. They're going to build their own mill. You know how much money that would cost? We're talking 800,000 ounces a year production. That's over. I mean, I can't even guess how much the capex would be for that.
Never mind the
So
time it's also going to take.
yeah, the mill's sitting there. I mean, come on, you got to use the mill. I mean, now the one thing that they could possibly do is they could buy it.
Mhm.
They could buy the mill, but then they still have to buy the mill, which is it's not going to be cheap. But we'll see what happens. But for me, yeah, so that's the ultimate optionality play. I'll give one other one. Another one we could look at like Southern Silver. They have like 350 million ounces of silver, and they're currently valued about 35 cents in the ground, maybe 40 cents in the ground.
Mhm.
Um, so if you can buy silver in the ground for less than 50 cents, and you basically you're going to get paid, and it's went up a little bit, but at one time you could buy Southern Silver for 25 cents in the ground.
Mhm.
And so that's optionality. So you want a good sized project. You don't want to buy a small one. I don't do optionality for 1 million ounces. Maybe 152 is probably as low. And silver, 30, 40, 50, it'd be about the minimum. But you kind of want big projects that are cheap. You're looking for good sized projects where you can buy them, $10, maybe less than $20 gold in the ground. And I like to go less than 50 cents in the ground for silver. Um, and those optionality plays, I mean, right now there was another one somebody just brought to me, Grand Portage, that valued like $10 million market cap, that they have, I don't know, like over 2 million ounces in, I think it's Alaska. That's an example of how the market is just ignoring gold in the ground.
Mhm.
So there are a few out there. I've done optionality videos where I do about 50 names. These stocks that are just, the gold in the ground or the silver in the ground is just really, really cheap. And those are the optionality plays. My exploration stocks in my portfolio, the vast majority are optionality plays. I prefer optionality for exploration versus drill stories.
Mhm. Excellent, Don. Well, I think that's a good place to kind of wrap up for today. Is there anything that you're looking out for or kind of expecting to or being cautious of into the end of the year here?
Yeah, I'm not. It's no fun to go through these deep corrections. You have to buy the dip on them. So the only I'm cautious because I'm worried about the stock market crashing, um, and when like I said, when it finally does roll over, gold's gonna get pulled down,
Mhm.
and so we're gonna have to go through this pain. So I'm not really looking forward to that. Going into the holiday season, these corrections are never fun, but you have to buy the dips, and so we have to get through it. But like I said, I've been saying this for 2 years, is that gold, the miners and gold are not going to fade the S&P crash.
Mhm.
We're going to have to go through that pain. That pain is coming, and until we get through that that event, we're not going to have the wind at our back.
Mhm.
That's always going to be in front of us. That storm, right? So that storm is still in front of us, and it could happen in Q4. It could happen in Q1 of next year. As a matter of fact, I expect it to happen either in Q4 or Q1.
Mhm.
So the storm is in front of us. We're going to have to get through that. But once we're through that, because I've told people that I'm waiting for the S&P to go below 5,500. So we're at 6,800 today. I think we dropped down to 6777, call it 6,800 today. We're going to go down to 4,000, which is which is a 42% correction in the S&P.
Mhm.
And I didn't think we'd do a 50% correction, but 3,500, I don't think we'll do 50, but I think we're going to do 42.
Mhm.
I think we're going to go sub 4,000. So that's a very deep, but I'm not going to wait for that. I think gold will bounce well before that. But I think 5,500 for me is a really good target for buying the dip. In other words, I think gold will keep going down until you get somewhere below 5,500. And then at a certain point, we'll get to decoupling. But I think the buy area for the next dip is 5,500 S&P to 4,500. That's the buy area.
Mhm.
And, I'm just hoping it doesn't get too painful. But it's going to be painful. But yeah, get ready to buy the dip. Thanks
Excellent.
for that, Tom. This has been a fantastic interview. We covered a lot of stuff.
Yeah, well, I mean, I like to be able to take the time to walk through everything because it is, there's so much of this that's all tied together, the internal macro to the external macro, how this plays into the stock market, how the Fed, where everybody is watching the Fed. There's so much of it to take into consideration. So I really appreciate your time, Don, of walking us through all of this stuff. Of course, for anybody that wants more of Don's stuff, all of his recommendations and valuations are all available at goldstockdata.com. Of course, on X as well, at Don Durrett, two R's, two T's, and Don Durrett, or substack.dondurrett.com as well. Don, thanks so much for your time.
All right. One thing I want to say about my website, because a lot of people come on there and I'm not a normal newsletter writer in that I don't write up companies. I
Mhm.
don't, most newsletter writers, they recommend stocks and they'll write up companies. I don't do that. So I don't recommend stocks that way. But what I do is, so when I got into this, I was looking for a website that provided data that gave me kind of leads where I could go do my own research. And so that's what gold stock data is. So, but what I do is I rate the stocks.
Yep.
So you can basically, on my search engine, there's like 850 gold and silver miners. You can say, okay, show me all the mid tiers, and then you can actually filter it by, show me, because I rate them. You can show me all the ones that have an upside rating of this, a downside rating of this. So I give you ideas on which stocks I like,
Yep.
but the purpose of the website is for you to do your own due diligence. Thanks for that, Tom.
Perfect. Don, thanks so much for your time. Always a pleasure to speak with you.
Perfect.